commodity. Taken all together, these are Stretch's total assets. Now we turn to the liability side of the balance sheet. These are all the debts that the company owes or that are expected to come due over the coming year. There are 5 categories of liabilities, and I have them all in my pocket here. The first one is the accounts payable section, or category. This is the amount of money that the company owes to its suppliers or to anybody that it buys things from. Now, you'll see here, if you look, the company bought $2 million of something, probably rubber, from somebody, probably Malaysia. Number 2 is notes payable, which is a fancy way of saying that the company owes money to a bank or other institutional lender. All right, that's the IOU section. Number 3 is accrued expenses, another fancy phrase simply to describe the salaries that the company owes its president and its workers and its attorneys, the money it owes on insurance premiums, pensions, normal expenses, which of course it pays for on these lovely green stretch rubber checks. And finally, there is the income tax. All companies, if they have a profit, must pay one, and that is true of this company as well. Taken together, these 4 are called the total current liabilities. In addition, of course, Stretch has some long-term liabilities, debts that are due sometime in the next year. Altogether, we've got total liabilities, everything this company owes. Now, the big question. Given what we've learned, is this a safe company? Or, to ask it more precisely, what is its working capital? Okay, let's zero in on just 2 categories. You can do this on any balance sheet for any company. The total current assets, everything that the company has right now, and the total current liabilities, everything the company owes over the next year. Working capital is the difference between these 2 numbers. The amount that Stretch has left over if it pays off all of its short-term debts would be the working capital. Or, $12 million is what it's got, $5 million is what it owes. That leaves a working capital figure for this company of $7 million. Is that enough? That depends on the size of the company, the business it's in. But let me give you a simple formula to help you make a judgment. Many analysts believe that the ratio of current assets to current liabilities should be at least 2 to 1 if the company is safe. 2 to 1. Well, 12 million over 5 million is better than 2 to 1. That's 2.4 to 1, which makes Stretch look pretty safe. Now, before we move on, I want you to take one more look at this side of the balance sheet. If you take all of these liabilities, all of them, this one and this, and subtract them from all of the assets, the number you come up with is something called stockholders' equity. If somebody comes along and says to the Stretch Rubber Band Company, okay, guys, I want you to pay off everything you owe, get rid of all your debts, what would you have left? You'd have the bedrock of the company. That is stockholders' equity. And clearly, the larger the stockholders' equity, the stronger the company. It's over here on the liability side for a very simple reason. A balance sheet has to balance. Now, if this company were doing well, there ought to be more weight on the asset side. If liabilities are equal to assets, then the company's owners would have nothing and would have to go out of business. By putting the stockholders' equity over here, which is really just assets after liabilities, then a healthy, let's see here, a healthy company balances out. Okay? That shows you if the company is going to be a safe investment. Now, if we want to find out if the company is going to grow, is it profitable, is it going to make more money in the future, and I think we do, for this we're going to have to dig out something called the company's operating margin of profit. And to find that out, I'm going to go down the hall to look for an income statement. One more thing here. Don't get income statements mixed up with balance sheets. The balance sheet reflects the financial status of a company on a precise day. It's kind of like a snapshot. The income statement focuses on profits and losses over a period of time, usually a year, sometimes 3 months. Why don't we go look at one? Actually, the income statement is really very simple. It compares how much Stretch or any company took in last year with how much it spent to make its products. Now, it's not just 1 year of figures. You can look over there and see that there are 2 years, last year and this year, for comparison. The top line on this chart is net sales right here, which is the main source of the company's income. In this case, it's the money made from selling rubber bands. Right underneath, this item here is everything that the company paid to make those rubber bands, which includes employees' wages, depreciation, executive payroll, sales, promotion costs, you name it. If it's a cost, it would be right along here. When you subtract these cost items from net sales, you come up with this line right here, profit from operations. This is a very important line. I'll be back to it in a minute, but first let's just finish the chart. The company makes a little money on the side. This is dividends and interest money from its own investments. So you add this money to profit, you get total income. Stretch also had to pay some, let's see, here, interest on bonds, set aside a little money for the federal government, taxes. So after you subtract, you get this bottom line item here, net profit for the year. Then you go to the very bottom line, this section here. This is net profit spread out over all the company's shares of stock, or earnings per share. Remember earnings per share? If you don't, you might want to roll back to segment 2. It's the E in PE. Now, let's find out what Stretch's margin of profit is, which is, after all, why I came over here in the first place. We want to know if this company is becoming more or less profitable, or more or less efficient in its efforts to generate a profit. So going back to that line I told you was important, profit from operations. If you divide this line by the line net sales, you'll find both these lines on any income statement. You will find the company's margin of profit. Let's do it. $2,200,000 divided by 22 million works out to 10% exactly. That's their margin of profit, which means that for every dollar that this company generates in sales, it holds on to 10% or 10 cents as profit. Last year, the operating margin of profit, if you do the figures on that column, works out to only 9%. So on the basis of that comparison, we now know that not only is Stretch Rubber Band financially sound, which we learned from the balance sheet, but we now know that it is growing and becoming more profitable. So this company is not a bad investment, not bad at all. All right, I don't know about you, but that was a lot of information, so this is a good time to take a break if you want. I'm moving on, and we'll see you in segment number 4, or as we like to call it, fundamentals.
Only companies listed on the big board must issue a corporate report. True or false? False. Any publicly held company must issue a corporate report. Which of the following does not belong on a balance sheet? A, net sales. B, marketable securities. C, stockholders' equity. D, notes payable. The answer is A, net sales. If you want to find that, look on an income statement. If you divide operating profit by net sales, you get the operating margin of profit, or as it is also called, the profit margin.